Well, the markets march on. Another strong overnight trading session saw markets across Europe gain, and that strength that was started in the Asia Pacific region in trading, particularly in Hong Kong yesterday, fed into European trading and then into the US. And we saw a new all-time high for the S&P 500s. I'd like to count up the number of times I've said all-time highs in the last 2 years. It must be an extraordinarily high number. The Dow up 0.6%, showing it was a broad-based rally. The Dow up 1%, sorry. The S&P 500 was 0.6. The Dow was up 1%. The Hang Seng, though, was the outperformer and has continued to be the high beta market of the globe, up 1.4% in trading today, and futures indicating we should see further positive momentum in Hong Kong trading today. So the outlook for global shares certainly looking very positive at the moment. There's no doubting where the momentum lies. Amazon up 3.7% last night. Palantir up 3.2%. Interesting to note, though, when we look at the Dow, the 30 stocks there, the bluest of blue chips, what really performed last night were consumer exposures and old school tech. Honeywell, 3M, amongst others. Top performers, as it appeared. Investors continue to spread their exposures, but want to stick with the tech sector that has worked so well for them. Commodities were also in focus in overnight trading. Oil fell almost 2%, reversing all of the previous session's gains. And it does look like the geopolitical environment is improving from a peace point of view or a human point of view, which means the outlook for oil is starting to decline. We're already expecting a surplus of supply in this quarter, somewhere close to 4 million barrels a day, and with more production coming online and doubts that the OPEC plus cartel can curtail their production, it does appear that there'll be pressure on oil. But peace in Ukraine and potential resumption of Venezuelan oil production means that those estimates of lower oil prices have been pushed even lower. And we could see further pressure today, particularly on oil and gas exposures. But we also saw metals hitting new highs. Copper, once again, all-time high. Silver, an all-time high above $80 an ounce, touching 81 briefly and trading overnight. We also saw all-time high prices for nickel. So it's very clear that this commodity outperformance we've been looking for is coming through. The underestimation of the demand for so many of these commodities is really starting to play out, not just in the commodity markets, but in the shares that are directly exposed to them, where we've got PE compression on the basis that prices could fall. With prices now rising, not only do they get the benefit of the increase in sales, but they get the benefit of a more optimistic outlook from investors, expanding their price to earnings ratio and increasing the leverage to those increases in the underlying commodity prices. So a thematic that we'll be returning to again and again over 2026. Today, locally in Australia, we had the CPI release. And of course, inflation, the key to the outlook for interest rates anywhere, but also here in Australia. Now, the headline rate is expected to be steady at 3.8%, but we know that the RBA focuses on the two other measures, the two core measures, and they're both expected to fall. The trimmed mean is expected to fall from 3.3% to 3.1%, and the weighted median from 3.4% to 3.2%. Now, it's very important that occurs. At the moment, we are concerned about inflationary pressures. The market has flipped on its thinking on interest rates, and the consensus is now that we're more likely to see an interest rate rise over the course of this year than an interest rate fall. And the readings today on inflation will speak directly to that narrative. Now, that fall will moderate concerns about rises. If the two core measures come in above expectations, we could see pressure on the local share market as that potential for interest rate rises becomes stronger. However, any surprises on the downside could revive that talk of potential rate cuts. And given that the market has been fueled largely by rate cut fever for at least 18 months, if we see an inflation read that surprises on the downside, it could reignite that fever, and we might see support, particularly for those banks that were hit so hard in trading yesterday. Also on the market radar at the moment is the fact that Constellation Brands will report tomorrow. Constellation Brands owns many of the biggest spirit names. Jack Daniels, I happen to know, is a Constellation brand. And the report that they give tomorrow will speak to consumer health in the US. So, of course, this is the kickoff of the reporting season. Next week, we'll be hearing from US financial stocks, kicking off with JP Morgan. But investors should be gearing up for the quarterly reporting season in the US, as we know it can be very influential on share prices. Now, in those performers yesterday, and a lot of that interest in the more old school tech had to do with the pickup in demand from battery storage. Now, this is a quiet boom going on in the background. And while there's been a lot of focus on EV, that demand for storage of particularly renewable energy means that we've got another kicker in the lithium cycle. And we've seen a surge in lithium demand. And there's been, I think, some complacency around the outlook for lithium. We certainly were in oversupply last year, and the big falls that we saw in lithium prices and in the prices of lithium miners reflected that. But it appears now, and particularly with the current focus on chip manufacturers, data centers, large learning modules, and the demands that they will place, not just on the memories that are available, but on the power that will keep these servers running. And that focus and that need to provide battery storage means that lithium remains in focus. Now, there's a lot of bullishness around lithium at the moment. It's a big turnaround from last year where bearishness dominated. A couple of the majors, Morgan Stanley and UBS, both arguing that we'll see a lithium deficit this year, a big turnaround, and are forecasting significant price rises. Now, lithium's not quite as commoditized as many other minerals, but nonetheless, trading around $19,000 a ton, US dollars that is, at the moment over 2025. Now we're seeing forecasts from those big investment banks of prices up to 28,000. In fact, in other words, an almost 50% increase in lithium prices this year. So the Australian lithium sector is up 5% already in just 3 trading days. In 2025, it rose by 38%, despite that very torrid start to the year. And lithium's becoming even more important as an export for Australia. Last year, we saw 5.2 billion in lithium exports for Australia. That's predicted to grow to 6.6 billion by 2027. So an increasing importance, not just to investors, but to the Australian economy. And it's suggested by many of those analysts who are making these bullish predictions that 2026 will be the turning point for the Australian lithium sector. So something to be looking at right now in terms of potential investments for 2026. And so when we turn to our watch list today, top of the list naturally, Liontown, one of the favoured lithium plays locally. Yesterday, its shares were up 15%. It's an extraordinary turnaround. And it's been a highly volatile stock. Let's be very clear about this. This is potential higher reward, but also higher risk because of that higher volatility. The 12-month gain in Liontown is now 246% from that low that we saw. They hit a 52-week high, better than 52-week high in trading yesterday. Revenue is expected to grow by 25% this year, reflecting that better outlook for the underlying commodity. And expecting revenue of 250 million in this first half alone. So a much stronger revenue outlook for Liontown, echoing that much stronger share price. Now, having said that, analysts are still catching up with this idea that they need to revise their commodity prices up. Many of them have bearish ratings on Liontown based on their price targets. Nonetheless, those target prices are below current levels because they haven't yet updated any commodity forecasts in some cases. Nonetheless, Liontown, not rated well by analysts, but showing very strong momentum right now. Turning to the US, and second stock on our watch list today is SanDisk. Now, this is a key to the storage demand picture, and that storage demand has been driving a constellation of stocks led by SanDisk. SanDisk was up 28% yesterday. Now, this is after it was the strongest performer in the S&P 500 last year. So it's pretty clear after a year's outperformance, beating the whole 499 other stocks, A 28% gain yesterday suggests the theme that drove SanDisk is yet to play out. The AI memory demand remains high, and there's a shortage of drives. There's a now, and we saw last night, a new NVIDIA product announced that needs even more storage. So analysts, despite the huge gains in SanDisk price, maintain strong buy ratings in the Moomoo community, and SanDisk, one that's leading the charge higher. And turning locally and to that commodity cycle potential, the global ex copper miners ETF jumped 4% yesterday, and with copper at record prices, that's hardly surprising. It hit its highest close ever, it's up 87% over the last year. There is a bullish outlook for 26 for copper. A number of analysts yet to move on the fact that the price has been exploding upwards at its highest ever levels. Global exposures for copper are not as easy to come by, although we do have a number of globally significant copper miners. The Global X Miners ETF takes an even broader and more global look. Its assets under management are up 55% since last September. Very good momentum in Global X Copper Miners ETF, and potential for further gains if that copper price continues with its strong momentum.